Stocks ended mixed today as traders reacted to a big headline out of Washington. The House passed President Trump's massive tax and spending bill, reigniting fiscal concerns. That news pushed bond yields lower, with the 10-year yield falling over 4 basis points, triggering a small rally in treasuries. But the real standout today was Bitcoin, surging to a new all-time high, even as other traditional hedges that have been trading along with it the past couple of days, like gold and silver, pulled back today. Sector-wise, defensive trades, which have been doing very well the past 4 or 5 sessions, took a hit today. Utility, staple, healthcare all rolled over, while Tesla popped on a technical breakout, giving us a little bit of a trade, trade opportunity. So in today's market outlook, I'll walk you through what's driving this unique intermarket setup today, where not everything kind of moves like they typically do together. How the sector rotation is shifting, and then break down a bullish long call vertical spread trade idea on Tesla. So let's go ahead and get started. Today is Thursday, May 22nd, 2025. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching on our blog, check out some of these other things over here on the right, including our Market Outlook live video, where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them or move on. We also, you can sign up for our daily Market Outlook newsletter by filling out this form and hitting that button, or you can do that up at the top as well. You can see the video here at the top. If you scroll down, you can see it's a kind of a written recap of what happened in the market today. Scroll all the way to the bottom. You can click on this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. Let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we finished near the lows of the day today. After, rallying, a little bit and not very much. The range was 52 points. The average is 99. So, that average has been coming down pretty fast. If you look at the ATR here, and we'll go to SPX so we can see the average on SPX. It was at 99 going into today, right? So 99.7. After today, it's at 96. So that's where it's going to be tomorrow. Just a month and a half ago, it was at 198. So when we look at that ATR and we think, oh man, we're only at 50 points. Well, that ATR is a lot lower. Now it's still relatively high, but it's a lot lower than its peak. It's really been coming down. So it wasn't that big of an update, but it was like we didn't really sell off more on what we did yesterday. But it was, we finished at the low, so it was bearish enough, and we did finish like 0.04% down, 2.5 points lower. But it was enough to keep the momentum line at oversold levels and to bring the near-term line down to oversold levels. Instead of bouncing, like we talked about, which is kind of that first stage of bouncing, is that get that near-term intermediate confirmation bounce. Instead of getting that and bouncing right back up, which I think probably we still could. We didn't really, like I said, we're only down 2 points today. So we're still, in theory, we're still at that low point. We can bounce off of it, kind of similar to this. But the reality is, most likely now, given how bad the short-term sentiment, so you can see when you're bullish, you don't get short-term sentiment this bearish until you start to break down, right? And you can see, like, even over here. Now, we did over here, but when we got, as bearish as we got here, we got bull tags. And even this got close, about as close as you can get to a bull tag. We were sitting on the moving average. We got the light pink shading. So that was about as close as you can get to. But, again, so you're either, when you're this bearish, you're either going to get a bear tag or you're going to get the beginnings of an intermediate decline. So, now again, nothing's 100%. There's still a good chance that we can bounce out of this, but that's not the best short-term pattern. It's a relatively bearish short-term pattern here, unless we can just rebound immediately tomorrow before the holiday weekend. The NASDAQ 100 kind of gives us hope for that because it didn't drop as much, right? The near-term line's barely below the 20th percentile. The momentum line's actually jumped back up above the 20th percentile. The momentum line wasn't very deep to begin with. It did not go down today. We were actually up 32 points, or 0.15%. So that gives us hope that we can just kind of rebound right back out of this and move up higher and continue on this bullishness. If you look at the Dow Jones Industrial Average, it was a lot more bearish, like the S&P. It's down. It was down today, barely, but it was down today. And so it's like, like that's not how we don't want the near-term line to get that low, because like I said, it usually means we're headed towards a moving. At the very least, we're headed towards a moving average, right? That's what these bull tags are. We head towards a moving average, and then you bounce off of that. And then finally, you look at the Russell 2000, and you say, okay, well, it's the same thing as the Dow. We're bearish enough to probably not bounce right off of this level, but maybe have a little bit more weakness going into the moving average at best, right? And at worst, the bull tag would be, starting a new intermediate decline. At best, it would be a bull tag that we bounce off of. And there's still a pretty decent chance. The intermediate line is still strongly bullish. It's still well in the reversal zone. Market sentiment's rising. In fact, the market sentiment for the S&P 500 is pretty darn close to crossing the midpoint, right? It's at the 49th percentile. We're still 4% above the moving average. So we're still bullish on the long-term basis. So you right now, you would expect the best case scenarios of any of these little pullbacks rather than anticipating the worst, which is pretty much what everybody does when there's any kind of decline at all. All right, now let's take a look at the weekly chart. So let's see, here we go. Okay, so you can see again. Remember we talked about this yesterday. Like where are we trading? It's a higher high. We got a slightly higher high. We're getting a slightly higher Hakunashi close. Now only about 7 points higher. But the question is, where are we trading now relative to this Hakunashi close, so we can get an idea of where we'll be next week? Well, the Hakunashi close is 58.84, and we're currently trading at 58.42. So we're below that. And then the midpoint of the range is right around 5,800-ish. And we're currently trading above that. So that kind of gives us an idea of, if we can finish 40 points higher tomorrow, that would be really good. If we finish 40 points lower tomorrow, then, we're going to be threatening, the midpoint and really getting a transition candle next week. And remember, the transition candles can be reversal or they can be continuation, and it depends upon what type it can. But at the very least, it would be a transition candle, so it wouldn't be necessarily a strong bullish week. And we'd be looking for, at best, kind of flat, kind of convergence type patterns. Looking at the 3 green arrow charts, we got red arrows now everywhere. Second day for the Russell, but we got red arrows in the histogram. So the next step would be probably get red arrows in the stochastics. They're all pretty close, 78, 79. The Nasdaq's at 90, so it's a little bit further away. It has to get below 75 to get that second red arrow. And then obviously the third red arrow, which would be a buy signal when you get 3 red arrows. The third red arrow would come when we get the move to the moving average. Looking at the 2-line version of this chart, we are still above the 17-day moving average. The MACD, though, has crossed below its moving average, hence the red arrow. So that means that now we are in this convergence mode, right? Where you're below the MACD is below its average. But when you look at the second number in this MACD, which is the 8 and 17 days, so that's these 2 lines. So the first step of weakness, which is not very strong, but getting below the 8-day, the first number is kind of one little sign of weakness. But getting below the 17-day means now we're bearish, right? Now we're pulling back. In this case, probably at least to the 30-day moving average, because you can see if we were to pull down to the 30-day moving average, the point of control is there. There's going to be some very strong support there. So if we were to get 3 red arrows, like I said, that's a buy signal. In this case, it would be a pretty decent buy signal because there'd be a lot of support unless we were to, break on the day we get the 3 red arrows. Are we going to how far below the moving average are we? Are we like 0.5%, 0.25%? Are we 2%, right? So you can see that would kind of give us an idea of how likely we were to bounce right back up and be bullish. Let's take a look at some of the other oscillators like the DMI. You can see we're still above 25 on the positive indicator. But the negative is falling back down, and this is falling, so the ADX is actually falling back down. So this light green shading is done now and won't be there tomorrow because the ADX is below 20. And we're still, like I said, well above the moving average, but we're losing momentum. We're still kind of really watching closely that gap as you'll see here in a second. If I look at the RSI and CCI, again, below 60 again, second straight day. So still bullish, right? We're still bullish there. That's not a bad thing, right? We're still bullish, but we're not strongly bullish. We're not trending bullish. We're not. Excuse me. We're not bearish, right? But it's not strongly bullish either. On either of those indicators. If I were to look at the Ichimoku cloud, still mature level, still above 85, barely, but still above 85. We're still above 5 up here on the trend quality. Both those levels combined, would represent strong bullish trends. We are below the green line, which is the midpoint of the 9-day range. 1, 2, 3, 4, 5, 6, 7, 8, 9. So the post, all 9 days now are after the gap. So that's why it's really run up here. But 26-day range is still based off of this low point, and then of course the high point that we've had. So that's why the blue line's not moving up very much. It's gone flat here. But we're, again, small sign of weakness to be below the green line. They're getting below the blue line is what matters. And rate of change still very positive. Look how big. I mean, the size of the cloud is pretty big. Like, it's bigger than I can see here anecdotally on the chart. So it's a pretty good bullish cloud there. If I take a look at the Bollinger Bands and the Keltner channel, so we were below the Keltner channel. We still are. The bandwidth is falling, so the bandwidth is moving back towards the Keltners. So that momentum is falling, but at least we're still in the upper half. So we're just losing momentum, but we're not bearish, right? We're still pretty bullish, still holding a lot of the bullishness that we've had. If I take a look at the intraday chart, of course we're not getting a new high. We haven't had a new high now for multiple days. We're still kind of worried about that. Like, we can't. If we were to get below today's low, yesterday's low, kind of in this area, and if we fill in this gap, that again, it means it's not a breakaway gap anymore, because there's resistance levels that we broke through when we gapped up. The 200-day moving average, the prior high point, right? The prior high, you can see that here. The 200-day moving average, the prior high point, the failed pullback bounce high point, right? So we broke above those. So if we were to fill in that gap, we would be back, falling back below those resistance levels. So again, and you can see how susceptible we are, because there's a big gap in volume because of that gap and because of how fast we moved. And we're sitting on it. So if we were up at new all-time highs or 4-week highs, we'd be fine. But considering that we're off of that and we haven't touched it and the green line's falling, it takes 6 days without a new high to get the green line below 70. But that would be next. Again, here's today, so Friday, and then Tuesday, and then Wednesday. So by Thursday next week, the high point, the low point, the channel's going to get really skinny, because the low is going to move all the way up here on next Thursday. And then if we don't get a new high by then, so this will really drop. But if we don't get a new high by then this line will be crossing like the 68. So it will be below 70. The red line will be back to 0. In a couple of days it will get back to 0. But then it will jump up too. And then now we got to start looking for, at that point, we're still okay in terms of where we are in the range. We're below the moving average, or below the 80th percentile, and the moving average itself is above the 90th. So that's not the greatest, but at least we're still in bullish territory. But again, as the range shrinks, then this number drops. Even if we just go flat, this number would drop. So we don't want to drop out of bullish levels below that 60th percentile. And then if I take a look here at I showed you the range was really small. The volume was right about average again. So the last couple of days you've had a pickup in volume. So the volume has been kind of stabilized over the past week, or since the gap. The volume has been pretty stable. The range is continuing to fall. Hasn't fallen below that 1.5% level yet, but again, we've kind of cleared one level at 2%. Now the next level would be to clear that 1.5%, and that would be a big deal for the markets. Finally, the VIX dropped today, not very much. Didn't drop nearly as much as it rallied yesterday. It still finished the day above 20. It still finished the day above 90%. So not at bullish levels. Remember, this is neutral range. So above 95 is bearish levels from a risk appetite standpoint, below 90 is bullish levels. But the VVIX closed above 100 again. Right? We wanted to get below 90 because that's trending levels, but we had jumped back above 100. The correlation had dropped below 50%. It jumped back above 50%. But again, the fact that it has fallen below 50% suggests there might be a jump in volatility forthcoming here, similar to what we saw again at the end of last year in December, when we had that kind of significant jump, just in a matter of just a day up there. All right, that brings us now to what's driving the price action today. It's kind of an interesting day today. There really wasn't very much of a move in anything. It was still kind of risk off, but it wasn't really a risk off day. Gold was down, the dollar was up, bonds were up, and so that, interestingly enough, that's not been really the risk off trade. It's the gold and silver and precious metals, those have all been kind of risk on, and real estate, you can see real estate down again. Emerging markets were down 1/3%. All these U.S. equity or international equities underperforming the U.S. counterparts because of that strength in the dollar. Let's take a quick glance at the 10-year yield. You can see dropped 4 basis points today after jumping 11 yesterday. So it dropped 4 basis points. We're still above 4.5%, the top end of the Fed funds range. So it's still a pretty high level. So we'll see, how much, if we end up peaking here on the near-term line and rolling over. If you take a look, let's take a look at it on this chart. Let's pull up the market forecast. So you can see it a little bit better here. You can see again, like if this is the peak for the near-term line, then that would be a really good, that would be a bearish peak. The yields will start falling back down, and I think that would be a bullish thing for the markets. Because we don't want to get above 4.5%. The dollar jumping today, but still in a bearish trend. Dark pink shading the red line. Short-term sentiment came out of the reversal zone, but still below the intermediate line. So we're not really out of the woods there either. And then I mentioned gold had a decline. You can see, it's still, it's yellow line because we closed below the moving average, but you can see just barely. The near-term line dropped below 60 and 50 in the intermediate line, but still not really bearish there. So it's still technically kind of a weak intermediate confirmation signal here. The intermediate line's bullish. It's not, above 80, which would be a stronger signal. But at least it's bullish and rising in the upper half of the chart. You have the dark green shading there. So gold, it looks like, we had, kind of a breather because we were so, we had such a crazy move over the past few days. In fact, if I were to go out to that May 15th, where it's kind of a lot of this rotation in the safety really took place. You can see gold was up 4.5% in those 5 days, and so it's down a little bit. The dollar was down a lot. Yields, bonds were down a lot, so they were up today. And so you can see, stocks struggling, and they didn't really bounce either. So it seems like today was kind of just a breather in this rotation trade, but not necessarily a rotation back out, right? Not necessarily a rotation into these other areas. As you can see, by the end of the day, equities were struggling. So it just seemed like it was like, okay, let's see if we really need to be this safety oriented or not, or can we get back into risk asset classes? And so far today, we didn't. It was a good day. It wasn't, we closed at the lows, but it wasn't a big down day, but it wasn't an up day either. So it wasn't like we didn't rotate back into risk assets after multiple days. And you see that in the sector rotation too. I showed you, we all know how much, the safety trades, how well they've been doing over the past 5 trading sessions heading into today. They're doing very well. Even with the pullback yesterday, they still held up their gains. And now they're still, they're still holding, they still outperform, just not by the same amount. And in these areas down here, technology, discretionary, are still underperforming, just not by the same amount. So when you look at today, just today alone, you can see, technology and discretionary were kind of small outperformers, but they finished, relatively low. We'll take a look at Tesla for our trade idea in a second in that discretionary space. But it seems like these kind of safety trades just didn't do as well because they're just kind of giving back some of their gains. So again, rotating out a little bit, but not necessarily rotating in. Just seems like kind of like a profit taking in this rotation trade, but not a, okay, let's go back. Now we're risk on again, right? If in fact, again, I'd like to look at the, let's see here, on this chart, I'd like to look at that relative rotation graph, right? Well, that's a really good visual of the rotation that we have into these different sectors. And so when you look at like XLK is still losing momentum and is crossing below 100. The XLY is excuse me, in the leading category, but it's also slightly losing momentum. You can see energy and industrials moving down to the left. XLC is moving down to the left. It's in the lagging category. And then your safety trades aren't necessarily going up to the right, but they're not going down anymore. They're just going to the left. They're just not going really down anymore. Let's take a quick look at the breadth today. So we talked yesterday about how the breadth had really kind of gone negative, but not breaking the minus 35 level. Sorry, I hit the wrong chart here. But you can see the breadth today is still like so as bad as as sideways, as today was. The breadth was actually worse today than what it was yesterday. And when I look at some of the other signs here, like the number of stocks above the 50-day moving average, you can see we're almost back to 300. Like, we're still barely above the moving average, the 20-day average at 294, but we're almost back below 300. And then the number of stocks above the 200-day, you can see is back below 250. So it's still above its average, but back below 250. So we're definitely getting some weakness in. We're not jumping up here. You can jump up here above the moving average and be bullish if the number of stocks above the 200-day moving average are increasing at a good rate. But if we jump up above this because the number of stocks above the 50 is declining, and that makes it go up, then that's not a good sign. And you can see the number of new highs has dropped down, only 30 new highs today, so below its average. And that's brought the new highs and new lows, net new highs and new lows down below zero again. We got to get back below 100 before we have to start worrying about it. But you can see the breadth has really turned around, where breadth was a really strong component. And it's still, it's not bearish, but it's not nearly as strong, and it's definitely showing weakness right now. And we'll see. We did get our new bullish and bearish index here, and we actually did finally have more bulls than bears on the AAII survey. You can see we got it to 1. If you look at, if I break them into their components, you can see we almost are above the average, the historical average for, let's see if I can find that here. I know I've got that up on one of these. It's not that one. It is somewhere around here. Is it this one? Nope. I've got it around. Oh, here it is, right here. So there's 37.7. If I take a look at the historical average here, let's go to the sentiment survey because it will tell us there. Historical average is 37.5. So we are just barely above the historical average. We're still not back below the bearish historical average. So we're very few neutrals, like very few fence sitters there. But it gives you an idea, okay, there's been a little bit of improvement in the bulls, but we're not getting rid of the bears yet, and that combination is what would be really positive, as we're trying to get up above these moving averages and stay up above the moving averages. And there's the, we're above zero, and you can see we got above zero a couple of times in 2022 in March, notably. Here, let me switch this to like a 3-year chart so we can see that. Let me see if that's enough. That might not be enough. It's not. I need to go 4 years. So you can see, during 2022, we did go positive. We went positive here in March for 1 week, and then it turned back down. And then here, and we did, we got close in August to zero, but we didn't quite get there. And we went positive there in February before the banking issues, and then we finally went positive for good. But so it's not unheard of to go positive, but we really need to get going and stay strong, get up here to these double-digit levels to really kind of maintain the positivity, and get eventually get the orange line to cross back up above the green line, and then now we're positive going forward from here. We're obviously still way down below that moving average. In fact, I can actually chart the gap between those two lines with that MACD down at the bottom. And we're still very, I mean, we're as negative now as we were at any point in 2022, about as negative now. And that's with the significant improvement that we've had in the last few weeks. So that's kind of like, so the breadth is improving, sentiment is improving, the money flow has improved, and we're not really getting any significant drop in money flow. We're still at bullish levels above 60. Getting below 50 now, we have to start to be worried about money flow. As you can see, that's when that typically lines up with the beginning of intermediate trends, and we don't have that issue yet, obviously. All right, that brings us to our trade idea of the day. Let's take a look at Tesla. Let's look at it on its market forecast chart. So bring that up here, and you can see it's got looks very similar to the market, to the regular stock market. You can see it got a lot of bear tags. We never really could build on any of them. We always dropped after we got them. But we didn't get a bear tag because it wasn't light pink green shading the yellow line. It was a green line by then. But same idea, and we finally did hold and build on it, and we took off to the upside and cleared all these other bear tag highs and intermediate lines in the upper reversal zone, near-term lines in bearish territory, but not oversold. The momentum line we had an intermediate confirmation signal yesterday, but it rebounded today, so it's actually looking pretty good. Like that it's got a good chance to continue and just bounce up higher, continue this bullish run. Good bullish candle here. We're currently trading above the Heikin-Ashi close, so that's a good sign. Even if we've been bullish for a while on that, we can get that golden cross going on. Obviously, we also have have had three green arrows here for a while. Today's volume a little bit below average there. If I take a look at the two-line version of this chart, we're above the 200-day moving average. We're above the value area in the past year. The 8 and 17-day are rising. The 30s above the 50. They're both rising. Momentum is peaked and stochastics is high, but I think you got a pretty decent, we have opportunities with options to be able to kind of ride out any kind of pullbacks, right? Unless you buy a call option, which we're not going to do. As you can see, the DMI looks positive. We're still above 30 on the positive indicator, well below 20 on the negative indicator. The RSI and the CCI are also still at positive levels. We're above 60 on the RSI, still above 0 at least on the CCI. Looking at the Ichimoku cloud, we are way through the cloud, easily through the cloud. The rate of change is significantly positive. We're flirting with a mature bullish trend going on there, so that's all very positive. And then finally looking at the Bollinger Bands and the Keltner channels, and you can see we're above the value area. There's very little, the bands are shrinking, the volume, the momentum is waning, but again, we can kind of get something like this is kind of what I'm anticipating, where we might briefly get some red dots, but probably nothing more than that. And so I think there's a good opportunity to be bullish without being strongly bullish. So what I decided to do here was to do a long call vertical spread. So sell the mid-30s, but at the time during the Market Outlook Live it was a mid-30s delta. So sell that one, buy the 370. Position size for a typical $500 for a directional trade, getting about a 3-to-1, and then this is all our flexibility. So we got a lot of time. It doesn't have to go up immediately. There's not a whole lot of negative time decay like it would be on a long call option. We can get volatility. If volatility were to increase during this pullback, that would actually help us here limit any declines that I have. So I like the setup for this long vertical spread with a pretty decent reward to risk ratio. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody. We'll see you all tomorrow.